Hey Tony, great to see you today.
Nice to see you too, Paul.
We've had a lot of market volatility in the last couple of months. A lot of market volatility that we haven't necessarily been overly involved in, as we've seen Australia and the US as a bit of a hot market that we've wanted to steer clear of that euphoria. Tell me a little bit about what you're thinking at the moment in terms of current markets and where we sit.
Where we sit at the moment is, I suppose 12 months ago we made a conscious decision that you used the word euphoria, and I think that's probably even not strong enough a word, that markets have been overvalued considerably, mainly due to the fact that you have a look, there's no growth left in them. So with exposure to the US markets and a lot of sectors in the Australian market, it just didn't make sense. There's no use investing money because you have it, you invest it because things are at a good price.
Yeah.
So as a result, for the last 12 months, we've had high exposure to cash and fixed interest, some emerging markets, Japan, etc. And that's probably had us underperform the markets up until around about 3 months ago. But 3 months ago, that meltdown, or what we call blood in the streets, has started to occur. And as a result, I think our portfolios have performed extremely well in the last 3 months. In actual, when markets are overvalued, it's about preservation of capital, and that certainly has what's happened. We've seen some horrendous falls. In the last 3 months, the Australian market's off about 12%, just the ASX 200. And you have, for the last rolling 12 months now, it's negative 7.4. So even if you invested in it 12 months ago, you're still negative 7.4.
Negative 7.4, yeah.
US market 12 months ago, you're up about 1%. But if you invested in it 3 months ago, you're up to nearly negative 20%. Depends once again what sectors you're in. So we've seen some major falls, but as a result of that, having the cash is what creates the opportunities when these markets do come back to fair value.
Do we start putting a bit more cash into play, or do we continue to be a little bit more preserved in what we do?
Oh, we're certainly more preserved. We're staying conservative at the moment. We don't think it's Boxing Day just yet. But when that does occur, I think we're going to slowly get in. So if you have a look at that curve where it's impossible to ever predict at the bottom of the market, but you know when things are starting to offer good value. At that stage, they still might get oversold, but if you're looking at the long-term trend, that's where you actually start to make the return. So at the moment, we're still being conservative. In actual fact, we've probably got back to our clients of more recent times have been even more conservative, and especially if new cash going in. We've held nearly 50% in defensive assets on a growth fund. But there's no doubt, and we will be going in, but you know very well how we do it. We do it bit by bit.
Bit by bit.
We're not going to say today's the day and let's go for it and fingers crossed. The best way of doing it is just on a bit by bit basis and going in.
Very good.
Yep.